The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're going to get you to be smarter than the average bear today because we're going to be looking at the One Big Beautiful Bill Act, and we've really learned a lot about it. Some good things, some things that I didn't think were in there, some things that I've learned. And we want to make sure that you take advantage of everything you can because so much of these changes are retroactive to 2025. There's a lot for 2026 as well. And I'm joined in the studio with Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
And it's beautiful today.
Oh, it's gorgeous. And ideal day.
And Christopher Fabian.
Hello, Esther.
Hello, Christopher. All right, so we're going to talk about things that we're going to talk about the change in the bill, and we're going to talk about things that you can do. There's some things you don't have to do. They're just in there. But there's some things that you can do and you'd want to do because some of the things are phasing out as well. And the other thing is we were kind of proud to hear this week that we were nominated to one of the best of Buffalo tax accountant firms, right?
Yep, absolutely.
And if you want to vote for us, we'd like that.
Yeah, best of 716, and you just go to buffalonews.com and you vote for hopefully us.
Right. And so we're in there. So if you like what we do and you want to vote for us, we would appreciate that. All right?
Most definitely.
All right. I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. You can text up to 716-8030930. We want to talk taxes. But I guess before we get started, I'm just going to talk to Mark. Hey, Mark, how can we help you?
Yeah, sir. I just wanted to know, for people that have filed the tax extension for 2024, when do they be completed?
October 15th of 2025.
Very much.
That's it?
That was a short one.
All right,
easy.
good enough. All right, thanks for calling, Mark. Have a great day.
All right, thank you.
All right. I'm Esther Gulius, the Tax Lady, 8030930, 8030930, star 930 on a cell phone. All right, so let's go into this thing item by item, and let's talk about it in relationship to everybody and their taxes. So the individual tax rates are going to stay the same.
Yep.
And they're indexed for inflation. The standard deduction went up. So now it's $16,300 if you're single, $24,500 head of the household, $32,600 if you're married filing a joint return. But what I'm surprised is in the past they gave kind of a bump to seniors 65 or older. Right?
Correct.
So they are giving a bump, but they took away the original bump.
Yep, they sure did. And
Right, Chris?
Yeah, so they're keeping it a single bump camel instead of a double bump camel. So with Social Security, they did not make Social Security tax-free.
They did not.
That did not happen. What they did was, if you're 65 and older on Social Security, instead of that little bump, they're giving you a bigger bump of $6,000 per person. So if you're joint, you could get up to a $12,000 increase in your standard deduction.
So before it was like $3,600 that they gave for people being over 65 married joint, right?
Right.
And so now it's $12,000. So that's good, but it's not great.
Right.
Yeah, because at first it was touted that seniors wouldn't pay any tax on their Social Security, and so this
That's not
certainly
true at all.
takes that off.
Not
the
true
table.
at all.
Right.
So, and then here's the other kicker. If you were a married filing separate senior, right, 65 or over last year, you would have still gotten the bump, right?
Yep.
You'd have gotten half the standard deduction plus your bump. This year, if you're a married individual and you want the $12,000, you have to file jointly. Or else you lose the $6,000 altogether.
Wow.
And a lot of these stipulations require you to be married joint. Now, if you were a single taxpayer, 65 or over, you'd get $6,000. But not if you're a married couple. The only way you get your 6 and 6 is if you file a joint return, if you're both over the age of 65. So that's something that we learned.
Yeah. Like there's somebody I do her tax return, and she always files married separate. She's over the age of 65 because I don't know why, but she wouldn't want to in this option.
No, she wouldn't.
Yeah.
Some of the benefits of filing separately are kind of really curtailed here. All right. The other thing is the child tax credit. If you got kids under the age of 17, effective 2025, and you don't have to do anything. You just had them. You're going to get a credit for them, and it's a credit, not a deduction. Now, the $6,000, Chris, is that a credit or a deduction?
That is a deduction.
Right. And so I want people to understand that a credit means this is money in your pocket. A deduction means it's multiplied by your tax bracket. And if you have a zero tax bracket, because after you take all the expenses, you have nothing left, you get a zero benefit, right?
Well, so as an example, if you're a senior, 65, right? If you had a $6,000 credit, that means your refund went up $6,000.
Right. But
the extra standard deduction would mean you get the extra bump in the standard deduction. So 6,000 times 10%, you saved $600. So
Right.
that's a big difference.
Right, so we want to make sure people understand the terminology, okay? All right, so the child tax credit, this is actual dollars savings. So your the child tax credit this year is going to be $2,400. I mean $2,200.
Right.
So it went from $2,000 to $2,200, which is good.
Right.
Which is good. And then the QBI stays the same, still at 20%, but effective 2026 goes to 23%.
Yeah.
Well-
and don't forget, Chris, what were you going to say?
I was going to say, speaking of children, there is a big change with
The
the
child independent care credit.
right.
I was thinking about that.
Okay, why don't you explain?
Sure. So if you used your FSA through work, you were entitled only to put in $5,000 into your HSA. Now they raised it. I know some parents out there are going to go, well, this isn't too big, but it is still better. It's now $7,500 you can put in your HSA.
So if you're paying for daycare, which we know is really expensive, if you pay for the daycare directly outside of your HSA at work, then you're going to be limited to $5,000, right?
Yeah.
Correct, Chris? But if you do it with
Through
your
your
HSA
HSA
at work, it's $7,500. So that's an extra $2,500 that you're able to take as a deduction.
Right, from old to new. And that means you save income taxes, you save Social Security tax, you save Medicare tax. So if you're in the 22% bracket, that just saved you almost 30%, that extra $2,500. So that could mean an extra $600, $700, $800 in your pocket.
Right. So if you have daycare and you are signed up with your HSA at work, go down and change it so that you can take advantage of the $7,500 versus the $5,000,
Yes.
which is a good thing. And again, some of these things that you'll make a little more here, you're going to make a little more there, you're going to make a little more there. Oh, they're going to take that away. And so we want to make sure that you know what to do. So I'm Esther Golias, the tax lady, and you do have to do some stuff. I'm the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930, and we're going to take a short break, and we'll be back on the other side. Hey, to us, you are family. And this is Esther Golias, the tax lady, with Tiffany Fabian, Christopher Fabian. We're chewing up the big, beautiful tax bill. And I have to tell you.
Oh, sorry.
Oh, wait, let me just say this. It is big, and parts of it are beautiful, but I guess What do they say? The devil's in the details, right? Yeah, Tiff, what do you want to say?
Don't forget, next week we have Mike Hayfleck on from the Financial Guys, and he's going to be talking about Social Security. The week after is Jeff Katz, and he's going to be talking about elder
care.
law and elder care. And then the week after, we're going to have a real estate expert on. And so we've got lots of summer exciting stuff coming up.
Right, that's right. And it's been a wonderful summer. Yeah, Chris.
Sorry, and speaking of summer and activities, you can see us live tomorrow at Pioneer Fest.
Right,
If
at
you-
Camp Pioneer.
At Camp Pioneer out in Angola. You can ask us questions right there about the big, beautiful bill. You can call in today. and
That's
get
right.
your-
8030930, 8030930, star 930 on a cell phone. We already sent out our newsletter, and if you go to our website, which we're having added, our newsletter is going to be added to our website as well. It will also go over the big, beautiful bill so that you know what's in it for you. And so that's part of what we want to do is that you want to make sure that you understand what's a credit, what's a deduction, how much is it going to save you if you need to do anything, and that's what today's all about. So, and you can text us at 716-803-0930. Okay, so the other thing is, all right, these are brand new deductions, and these would be over and above itemizing. So you don't have to itemize to take these deductions, but it is a deduction.
Correct.
Not a credit.
Right.
So what we're talking about is going to reduce your adjusted gross income, but it's not a credit, it's a deduction. So the first thing is, and it's a lot of money, tip income up to $25,000, whether you're single or filing a joint return, provided your income, and the limit is, let's see, what is the limit? I think it's $150,000 and $300,000.
for tips and social tips and overtime.
Right. So, so if you're somebody that's gotten tip income and they're going to put out in the next couple of weeks which job classification will qualify. So if you're in a non-qualified job status, even though you might be getting tip income, and Chris, you were talking about that just before the show, if you're not in that listed category, then it won't be deductible.
Right, like they said, like what I was reading, servers qualify, but if you're the busboy, the hostess, or the chef, and you get part of the server's tips, you don't get that benefit.
Right.
Yeah, it's so funny. People are calling the office and asking, and just like you said, Esther, they're releasing some of the requisites and the deals, the digits, the situation, the circumstances, and all the details.
Right. The devils are in the details.
Yeah.
And so here's the first thing I'd like to say about tip income. Thank God that's great that they're working and they're usually on the lower end of the spectrum, and the first $25,000 is tax free. But here's an interesting look at this. If I'm single and I get tips, Chris, how much can I take up to?
$25,000.
What if I'm married filing a joint return?
$25,000.
So if we weren't married and I was a server and you were a server, how much could we take on our individual returns?
We each would get $25,000
Right.
for a
So
total of 50.
who's getting shafted?
The married
Couple.
person.
Right.
Of course.
So
And married.
and by the way, if you're married and you don't want to file jointly, you lose the deduction altogether.
Right. So if you think I'm going to get away around it by filing separate, nope, nobody gets it then.
Right. So if you're in the process of getting divorced, and again, this is not just telling you what the tax law is, but we want to make sure that you figure out the best way to handle it.
Yeah.
You want to make sure that you get your divorce done by the end of the year if you possibly can, because if you don't file a joint return with them, you lose the up to $25,000 deduction.
Right. And also, it only saves on income tax. You still have to pay Social Security and Medicare tax on that.
Right, but the employer pays half of it anyway.
Yes, but
right?
still.
Right, I gotcha. But okay, so that's one of those changes that the devil's in the details. And so you want to make sure if you're in the process of getting divorced, call your attorney and say, hurry up, Jack. I want to get this done. If you're a server, right? Or a hairdresser or a nail person.
Yep. That's
Okay.
right.
All right, let's go to Mike in Wheatfield. Hi, Mike. How can we help you?
Hello. In
Hi.
yesterday's Buffalo News, there's a reprint from the New York Times. In the big, beautiful bill, it says you could win $100,000 and lose $100,000 at the casino, and then pay taxes on $10,000. How does that work?
Okay, so that's starting in 2026, and that's absolutely correct. So what they're doing is they're saying only 90% of your gambling losses are going to qualify as a deduction.
Well, in the past, you could take it all. I mean,
Right, okay, but first of all, you had to be able to itemize, okay? And that's still the case. But now what they're doing is they're saying, oh, if you have gambling income, you have to claim the income, but only 90% of what you lost is going to be deductible. And their logic is because people aren't claiming the correct income, that they've actually gambled and won more than what they're reporting, and so therefore they're limiting the loss. Now, again, no matter what, you had to be able to itemize. So most people, and you guys sitting here, most people weren't able to take it anyway because they weren't able to itemize. Now with the SALT deduction, you may be able to itemize, but that's the case. Starting in 2026, only 90% of your losses will be deductible.
Well, would that be something like applied like bingo income too?
All income,
gambling.
all gambling income is taxable. And what they're saying is that people aren't truthful in the income side, so they're going to limit the deduction side.
Well, that should stop some people from gambling.
Well,
I
which
doubt
is
it.
not all bad either.
No.
So, but thanks
Okay,
for
then.
bringing that up, Mike. I
you.
appreciate it. All right, thank
Yeah,
you.
that's I mean, there were so many people who were gambling, and they were under the misconception that you could write off your losses up to your winnings, but you can't really.
Well,
Well, you
Not-
can in 2025, but the truth is, if you aren't able to itemize, it didn't make any difference anyway.
Right, that's what
But
I'm
in this
saying.
situation where he had $100,000 in gambling income, and if he did have 90,000 in losses, he'd be able to itemize, but he isn't getting the full tilt because, especially if they're filing a joint return, right?
That's right.
They're going to get the 12 and the higher standard deduction, or the 90. And so, actually, with this higher standard deduction, they would have had deductions of 50 on this hand and 90 on this hand. So, really, they're not getting any benefit at all.
Right.
40,000. So, all right, let's go back to the phones. We'll talk to Harry. Hi, Harry. How can we help you, sir?
I believe you may. I'm going to give you as much information as I can. right
Okay,
away.
wait. I'm going to write it down. Keep going.
Okay. I had an income last year of $61,587.
Uh huh.
I paid on a
Well, wait. What kind of income? What was the source of the income?
there was a private pension and Social Security.
All right. How much is your pension?
Hang on.
And I'm going to tell you why I need to know, Harry. All income is taxed differently. Pension income is taxed differently than Social Security income. So some of your Social Security income might not be taxable at all, and that's why I need to peel off of that 60-some thousand. How much of it was Social Security?
It was around 30,000, 31,000, something like that.
And so what you're saying is your pension's like 34,000?
Around 31, 32,000.
All right. So are you married?
No, I'm not.
All right. You're single. All right. So the question is,
What's
Well,
your,
here, my question is, I paid in federal tax $21.70 out of the federal pension.
okay.
Out of Social Security, I paid $43.87 out of Social Security
Okay.
or Social Security pension.
Okay.
Now, my question is that out of the total federal tax paid was $38.87 on $61,587, and I received a refund of $26.70 and a state tax of $27.
Okay. But what's your question, Harry?
My question is, what should I do this year regarding the Social Security? Should I take more money away from
The withholding.
withholding of the pension and put it into Social Security, or what should I do here?
All right. So what's going to happen is your $32,000 pension is still going to be taxable. Your Social Security of $31,000, half taxable is 15.5. So we got 47.5 in taxable income. Now, your amount over your $25,000, because that hasn't changed in years, is $22,500. So that half of that's going to be taxable. So about $12,000 plus your $32,000. I've got my 5. So we got $45,000, and that's going to be AGI. But your standard deduction this year is going to be 21 plus his 6.
That includes.
All right, so your standard deduction is going to be $21,000. So your taxable income is going to be $24,000. So you're going to pay taxes overall of about $2,800. And so if you're having $6,500 withheld, you're way, way over withholding.
My question to you is, should I?
Yeah, well, I'll tell you, when you take a look at $6,500 in withholding, you can see that you're over withholding by $3,700. So I'd stop my withholding at Social Security for the rest of the year.
Oh, that's the question I had.
Okay, but just one caveat here, and I got to rush for the news. Call us on Monday so we can go over all the actual figures, because I don't want to mess you up. Okay, Harry?
Fine.
All right, I'm going to break for the news. I'll be right back. Thank you. I'm Esther Gilius, the tax lady from EG Tax. Be back right after the news. Hey, this is Esther Gilius, the tax lady from EG Tax. I'm joined in studio with Tiffany Fabian, Christopher Fabian. We're trying to figure out some place to go for dinner. Any good suggestions out there?
Yeah.
I want to go someplace fun. But anyway, but we're talking about the OBBB Act, the One Big Beautiful Bill Act, and we are learning more about it. So we're trying to get you so that you know what to do to make sure that you get the maximum benefit. Right?
Right.
Okay, so the other thing is, so we just talked about tip income, $25,000 with your single or filing a joint return, but you don't get $50,000 if you're filing a joint return. You only get the 25, up to 25. And in order to get it, you have to file a joint return.
That's right.
If you're married.
Yeah, that's true. Overtime pay. Now, this is where they segregated it. If you're single, it's up to $12,500 as a deduction again, or $25,000 if you're filing a joint return. Again, if you're married, you have to file a joint return in order to get the deduction. And again, it's limited to $150,000 and $300,000 in adjusted gross income to get the benefit. So now here's my thought. So we were just talking about the $6,000 for people over the age of 65.
Right.
Mm-hmm.
But if you're under 65, it doesn't make any difference, right?
Right.
So you don't have to worry about filing a joint return to get the $12,000 if you're over that income threshold, right? And if you don't have tip income, and if you don't have overtime.
Right.
You're free to file married separate.
Right, but if you have those things,
Then
that's a caveat.
different. Right.
That's right.
That's right. But so on the overtime pay, that again, this is a deduction. So if you're in the 20% bracket, you're going to save 20% of $1,250 or 20% of $25,000. So you're going to save substantial money, but it's not a credit; it's a deduction.
That's right.
So just wanted to make sure. And again, if you're under the age of 65, you don't have to worry about getting that $6,000 because you don't qualify for that. So you're just going to get the standard deduction, which is pretty hefty. It's $32,600 filing a joint return. But you have to figure all these things out because you have to figure out what's the best thing for you to do.
That's right.
Right?
You just have to put the pieces together and have the best outcome.
I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. By the way, if you didn't get our newsletter, you can get it online. will that be out pretty soon, Chris?
Yeah, it should hopefully be there Monday. So
Okay, so it'll be on our
Website.
our website at egtax.com, and you can also call the office, and it's all pretty. Tiffy did all the pretty stuff.
Thank you.
And we'll send you out a copy. All right?
Yep.
All right, we have a text here.
We do. It says, "Good afternoon, EG Tax. My mother has gone into hospice care. That's so sad. Hopefully, Medicaid is paying a big portion, but they're still taking her pension and her Social Security in her pension, and Social Security is her pension and Social Security still taxable on her personal return. Is this still a tax liability?" Yes,
So
it
it's
is,
like
but you get to write it
it's
off.
like making spaghetti sauce. You put everything in, and what comes out doesn't look like what you put in. So yes, all of that stuff that she gets, all of her interest income, all of her Social Security, all of her pension on this side of the ledger is on a tax return. Because she has such large medical expenses, then on this side, on the right side of the ledger, you get to deduct all of her medical expenses. So if her medical expenses cause her to be able to itemize, I'm assuming that she's single, so she'd be $16,300 plus the $6,000, so she'd get $19,300 and a standard deduction. If she has more deductions than she has income, then she won't pay any taxes. And if it sounds like she's not private pay, it sounds like she's on Medicaid, or you're going to get her on Medicaid. If she were private pay this year, then for the private pay portion, you'd be able to get a credit on New York State, right, Tiff?
That's right. That's right. There's a credit on New York State for it's up to what is the percentage, Chris?
6%.
it's the bed tax. You
Right.
get the bed tax, and they charge like 6.75%.
And you can deduct 6%.
You get a refundable credit of 6% of what the actual. If they charge you $400 a day, what you get back out of the tax, 400 times 6% is $24.
Right.
But 24 per day, $24 times 365 days.
Now you fixed it up really good, Chris. Now this is
Yeah.
hard. You got to get your abacus
I
out.
got my calculator. $8,760.
And it's a credit.
A refundable.
Refundable credit. And if you are doing private pay and you don't ask for that money on a New York IT 258, then you are letting them keep your money.
Yeah, but don't forget, I think you already said, is on the itemized deduction, you'll get to write off the cost that she pays. And so that'll help you. I was just doing a tax return for somebody who they took $171,000 out to pay for nursing home charges for their sister. But the only problem is the cost for the nursing home that I wrote off on the Schedule A, which is subject to 7.5%, was only $85,000. So they were still owing about $22,000, and they just couldn't wrap their brain around it. So it was very difficult to understand.
Yeah, and like I say, on the left-hand side, you got all the stuff. On the right-hand side, you got the deductions. So, but that's why it's good before you take the money out of your pension plan, call us. We don't charge you to talk to us.
Right.
Right? We want to help you.
Yeah.
All right, let's go back to the phones. We're going to talk to Tony. Hey, Tony, how can we help you, sir?
Hi, Esther. Just a dumb question.
There is no such thing as a dumb question.
Oh, well. I own a double in Buffalo that I've owned for around 40 years. I don't have a mortgage or anything like that. And I wanted to sell it, but I wanted to know, is there any other way to avoid the capital gains tax besides the 1031?
Not really. The 1031 is when you would exchange that double for another income-producing piece of real estate. And so the basis on your double would go then to the new piece of real estate, and you wouldn't have to pay the taxes. So there's all kinds of creative 1031 exchanges that you can do. For instance, I know several of our clients use Russ Gullo, and they do a kind of a passive 1031 where they exchange their double for a part ownership in like a mall or into
Student housing.
Anything like that. And basically somebody else runs it for you and you just get the money and a K1 at the end of the year. So that's something to think about. But more than anything, Tony, you'd be surprised what does your other income look like?
Oh, probably between me and my wife, probably like $150,000.
Is that including your Social Security?
Yes, ma'am.
So what are we going to do? Peel off around 40 in Social Security, right? Between the two of you?
Yeah, pretty close.
Okay. So that means 85% is going to be taxable, 32, so we got 180. All right. So you're going to end up paying. Now let's talk about what do you think that you'd sell that double for?
Oh, about 300.
300,000. Okay. Have you put anything into the house recently, into major remodeling, anything like that?
Yeah, I'm doing the downstairs flat now. I've been doing it for about a year.
Okay.
No
So,
plumbing,
like,
no
what do you
kitchen.
think you got into this remodel?
Oh, about 30,000.
All right. So, looking at a realtor expense of 18,000, 6%, and 30,000 in remodeling, you're looking at $48,000 in expenses. So with the deed stamps and everything, so let's say that your gain is going to be like 250,000. The maximum you have to pay is 20%. So you actually would only pay about and
then Tony, while she's
about $50,000.
Tony, while she's figuring it out, because your wife and you make about 150, have your losses on your rental, if you've had any, been suspended for a few years?
No.
You always get to claim your losses?
Well, I bet she doesn't have losses because he has no mortgage or anything.
Yeah, because I was thinking, if you had any suspended losses, the year you sell it, they become resurrected. Okay.
But anyway, so you would only owe about $50,000 in taxes. So you'd walk away with your after your expenses around $200,000. The bad news is the state of New York is going to charge you the full boat. But it's not that bad when you think about it, because it'd be about, with the state of New York, about $70,000.
Wow. To us, giving New York State, giving
20,000.
anybody for that matter.
Tony, my buddy, I get you, but then take a look at the 1031. Give us a call. We'd be very happy. But I'd talk to Russ Gullo if I were you.
Okay, so I would be okay if I called some of you or your...
You can call us anytime. Call 632-7886. That's our corporate headquarters, and all of our staff there is all senior management.
Esther, before we go, I just want to tell you something.
Uh-oh.
I don't know if you're aware of what a tremendous help you are to goofballs like me, who really, you have so much information at your fingertips. It's unbelievable.
Well, thank you. That's very nice of you to say so.
Well,
we really do care. So.
Well, you can tell. You guys know everything.
Well, we try. Well, thank you, Tony. That was very nice.
You should run the government.
I would love that. That would be fun.
Yeah.
I would straighten everybody up, but then I'd get shot in about a week. So, hey, thanks for calling, Tony.
Thank
All right,
you.
bye-bye. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And we're going to take a short break. We'll be back on the other side. Hey, Tony, you were so nice to me. Chris said, wait, I got another thing Tony can do. Chris, tell him.
You could actually sell the property and hold the mortgage. Don't have them go through the mortgage company. You hold the mortgage. They pay you. This way, you don't pay tax on all of it all up front.
You're still going to pay the taxes, but over the life of the mortgage.
And you save 5%.
And you can get a better interest rate.
Right. They pay you the interest, so you're gaining money that way. So it's almost like another pension you're getting in. So
right. So like when I said you'd have to pay $70,000 in taxes, you would pay almost that amount, but you're going to spread it out over 20 years. And again, that's a great option for you too. So you'd be basically acting as the bank.
Right.
All right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And what do we got, Tiff?
It says the last caller said that what we all think. That's the best part of my day. You guys are great assets to the community. Thank you. Give out the information where you can vote on the 716. You go to buffalonews.com, and Buffalo News sponsors it and does the best of 716 every year. So you go to buffalonews.com, and they're doing the 716. It's for different categories like hair and beauty, restaurants, accounting, financial planning. So you have to click on tax and accounting. And so it's different categories, and you vote on all the areas of 716. And I think if you vote on so many categories, you can be put into a pool and win a gift certificate too.
Oh, that's nice.
Yes.
Okay, now here's something that, and again, we're talking about the big, beautiful bill. So many people are paying a gigantic amount of interest on their car loans. Starting 2025, your car loan interest up to $10,000 is a deduction. Now, then you go, shoot, I bought the car last year. You can refinance on an existing American assembled vehicle. And you have to put the VIN number, by the way, when you do this deduction. And they'll allow you to retroactively go ahead and do the new car loan. And again, it can be even a motorcycle.
Yep.
And you can take up to $10,000 of your interest moving forward. I mean, that's something I would do tomorrow.
Yeah.
No, not tomorrow because it's Sunday. Monday.
Yep.
I just saw coming down here this afternoon that one of the credit unions had car loans for 3.99%.
I know you were at our house yesterday, and Gracie had her friend over, and you were saying, "Oh, do you got a car loan?" I mean, you're working it, which is great because you're always trying to think of ways people can save.
I'm thinking if you do a little bit here, a little bit there, if you do a little bit here. I mean, if you can cut, if you're in the 20% bracket and you got $10,000 in automobile interest that you're able to take off, you save $2,000.
Yep. Pretty cool.
So again, it would require you to pick up the phone and call your credit union or your bank and say, I owe $30,000 on my Jeep Wagoneer or whatever, and I'd like to refinance. They're going to give you, and then you get to take the interest up to $10,000.
That's a little here, a little there.
A little bit here, a little bit there, and it's all wonderful. Okay, and then for people in business, 100% bonus depreciation is allowable effective 2025, and it's retroactive to 2021. So if you weren't able to do bonus depreciation of 100% and you have a business and you haven't taken it, you can amend the last 3 years' returns and get that changed.
21 is going to die soon. Yeah, 21 already died.
21 died.
Well, I'm just reading what it says. Retroactive to 2021.
21 died.
So I don't know.
I don't know. We'll figure it out.
Let's see. Then let's see. Oh, the other thing is for those of you that are paying high interest, not high interest, that are paying high expenses for your health insurance, because you have to do that. In order to deduct the health insurance to qualify for the
marketplace?
Marketplace.
Okay.
It has to be a certain kind of insurance, right?
Yeah.
Bronze or silver.
Right.
Now they'll let you get into the marketplace on even catastrophic.
Oh, that's good.
So that means it's only hospital.
That's real. That's you to tease all that apart.
I mean, isn't that great? And the other thing is they have permanently gotten rid of the personal exemption. But a lot of times we wonder if you are able to claim somebody as a dependent. And if it's a non-qualifying child, the income that they have to have in order to qualify them as a dependent is $4,050.
Yep, which is close to what the old personal exemption used to be. So it's something that you can use as a marker.
All right, we talked about the child care credit. We talked about the adoption credit. That's another change in the law. Now the adoption credit is how much? You guys know how much off the top of your head?
About 14,000.
Yeah, and then also don't forget if you could deduct up to $14,000 of expenses, and don't forget if you spent nothing for the adoption, but it's a special needs child, you get the credit regardless. And a special needs child is even a child who's over the age of what, Chris? Do you know?
3.
3. So they're considered a special needs child just because you're adopting a child who's over the age of 3. And even if it costs you nothing, you get to deduct those adoption expenses.
Right, but now it's got a $5,000 refundable credit attached to it.
Right.
So it used to be just the credit. Now they actually give you $5,000. And then last week, I think we talked a little bit about the change in charity, and that starting in 2026, the first $1,000 in charity that you gave, if you're single, $2,000 if you're filing a joint return, is going to be a direct write-off as opposed to an itemized deduction.
Yep, which is really nice. That was something they did a few years ago during COVID, where you could deduct $300 even if you didn't itemize, and now they've increased the limit, which is really good.
But something negative that's happening is that let's say you gave $10,000 to charity, they're going to make you reduce what you gave to charity by 0.5%.
Yeah, and the QBI is still an animal that you could take advantage of, and a qualified charity of your IRA.
Oh, you mean the QBI, right.
Yep, and so don't forget.
Well, explain what that is, Tiff.
So if you are at the age where you have to take required minimum distributions from your IRA, you can take the required minimum distribution up to $10,000 and roll it
$110,000
and roll it right over to a charity instead of taking the money. And so if you're a philanthropic type of person,
what kind of person?
Philanthropic.
My brain's not working. Philanthropic type of person, you might want to do that, and so that way less of your Social Security becomes taxable, and so it's a great opportunity to take your IRA, and it doesn't have to be that amount. It can be any amount that you deem that you want to roll over to a charity that's a 501c3.
Right. Absolutely.
And one thing too, no one's talked about what are all the states going to do.
That's, I mean, that's what we do for a living, but it hurts my head because all this stuff is going to be peeled off by New York State.
Probably.
You know that. So you're going to end up with two different, we do this now with the depreciation, right?
Yep.
But it'll really be that much more. And then of course, the Trump account, that would be for children up to age 4 that were born in 25 to 28 through 28. They're going to give you $1,000 to open up a bank account for your kid. They're saying kind of like with IRA rules. And every year you can add $5,000 to that account until the kid is 18, and then they can take the money out for higher education, to start a business, or to purchase a home. And if the child is 4 or over up to age 8, then they also will qualify for the Trump account, but they aren't going to give them $1,000 seed money like the kids under the age of 4. You just can then put in $5,000 a year.
Yeah, and I just want to stress to people, if you are getting letters in the mail, make sure you give us a call at 632-7886, and for no charge, we'll help you with the letter. I had several texts this week. One of the letters that somebody got is that they're in the process of adopting a child, and they've had the child in their care for years, and so we did head a household, and we claimed the child, but the IRS is backing away the credit because the Social Security number that she has for the child was issued in 2025, and so it gets very complicated. So I don't want you to just fall back on the sword or fall and pay it.
All right, and then there's this other thing, we're talking about kids and everything. There's this this credit, again, credit, not a deduction, up to $1,700 if you give money to a charity that gives scholarships to children for educational purposes. So it's a state control. Looks like it's a state controlled charity. That would make it scary. But you can give up to $1,700 a year, and they give you a $1,700 credit for that. So if you put it in, you get it back.
That's really, and then you can choose the school that they go to. Would it even qualify for homeschooling?
Yeah.
That's pretty cool.
But again, they have to award the scholarship to that. So, in New York State, I don't know what the qualifications would be, because you're going to have to go through an agency to do that.
So it's not like you donate to St. Mary's. It's a specific
one
charity.
I was hoping that that's what it was going to be. If you got kids going to St. Mary's, you say, here's my $1,700, and they go, okay, well, we're going to take that and use it for your kids' education, and then you get a credit for it. It doesn't look like that. It looks like you got to go through this agency. And again, as this thing rolls out, we will have more information on that because there's so many if, and, ors, or buts, I will tell you. But again, for the HSA, you can get a bronze plan or a catastrophic plan, and so you no longer have to have that silver plan or higher, and that'll save you money on your health insurance.
And it doesn't look like they're doing much with the college credits, the AOTC, and the lifetime.
Oh, and I know what else I got to. This is really quick before the end of the show. The energy credits are expiring December 31st. Mm-hmm. So if you need doors, windows, furnace, hot water tank, insulation, you better make sure you get it done if you want the credit on the 2025 return. And if you are interested in an electric vehicle, that expires September 30th.
I know we just had a caller the other day when I was in the office on Thursday, and they wanted to know the furnace. If they got a furnace in 2025, would they be okay? And
they
still
better
get the credit?
hurry up.
Yeah. And so the answer is they have until the end of the year to get the furnace for their houses. And boy, all those companies who
got to go.
All those companies.
But she's
who
wonderful. If you want to talk to her in person, call us at the office. Anyway, I'm Esther Golias, the tax lady. Thanks for listening. We're going to go have fun someplace right now. And if you need us, 632-7886. Thanks for listening. Bye-bye.